Hello, everyone, and welcome back. My name is Rachel McIntosh, if we haven't met already. So, as we've been talking about all day, the impacts of COVID-19 are far too many to count. But one thing is for sure, the rules of the game have been changed. Financial markets, which have always been unpredictable, as you know, have taken on new dimensions of volatility. Asset prices have been fluctuating accordingly. So in the game of 2021, who will the winners be? In this session, we are joined by Danny Salman, the Senior Market Analyst at MultiBank Group. Oh yes, let's give a round of applause. Yeah. Danny specializes in market research and has worked with leading financial institutions across GCC and Europe. Today, he's going to share some key insights on market influences, including economic growth indicators in the United States, the activity in the IPO market, and environmental, social, and governance factors in capital markets. There will not be a Q&A at the end of the session, but Danny invites all of you to come to booth number 5 to have a personalized discussion with him after this presentation. So let's welcome him to the stage. Thank you, Danny.
Thank you. So, good afternoon, everyone. Thank you for the intro. So today I'll be presenting my topic on navigating market volatility and capturing opportunities in equity markets. As we all know, the year 2020 has been a year full of surprises. A global pandemic and shutdowns of economies worldwide. But fortunately, we're on track for a strong global economic recovery in the second half of 2021. But before I begin, I would like to mention and highlight that in order for one to understand the future, one must look at the past. And so during the pandemic, 3 recovery scenarios were mapped out by top institutional investors and asset managers, and each were given a probability of occurrence regarding the US economic recovery. So let's take a look at these recovery scenarios. We have the V-shaped, which is characterized by a sharp decline and a quick recovery, and that was the best case scenario and was given a 30% probability of occurrence. Second, the U-shaped is defined when metrics such as GDP and employment remain suppressed for 12 to 24 months, and that was given the largest weighting at 55%. That was the base case scenario. And finally, the L-shaped, which is defined when economic growth is stagnant and will likely persist for many years. That was the worst case scenario when it was given a 15% probability of occurrence. So any ideas on which economic recovery scenarios actually took place? Well, let's take a look. As you can see, this is the S&P 500 price chart, and this index is seen as the overall health and gauge of the US economy. And we can see a nearly perfect V-shaped recovery. So in summary, we can conclude that most asset managers and institutional investors were predicting for a U-shaped recovery, when in fact what we've witnessed was a nearly perfect V-shaped recovery. So we also see the same phenomenon when it comes to GDP growth rates. They have been revised multiple times throughout the year, and they have also been revised for the year 2021. And so the IMF revised global GDP growth from 5.5% to 6%, and for US GDP growth from 5.1% to 6.4%. And so what supported growth and will continue to support growth in the future? Well, we can largely attribute that to 3 main catalysts, and one of which, to begin with, is the vaccination rollout. The vaccination rollout that is currently underway is the largest vaccination campaign that has been taking place. And if we look at US statistics, already 260 million doses have been administered to its citizens, amounting to 40% of the population. And based on some forecasts, 60 to 70% of most developed economies will achieve immunity. And then we have the largest US stimulus package amounting to $1.9 trillion. And this stimulus package helped recharge and supercharge the economic recovery for the US economy. And it's important to note that they will be the fastest growing developed economy moving forward into 2022. Now, unfortunately, most countries cannot match the US fiscal firepower. However, they'll be benefiting from what we call a spillover effect. And that spillover effect will boost GDP growth rates by 0.5% for some countries in Europe and Asia, and will also lift global GDP growth by 1% in the next 12 months. And so I'll be focusing on 3 key themes for capturing opportunities. And so what you've seen from the previous slides is that we've went from worrying that growth will be too slow to now worrying growth will be too fast. And it's important to mention that markets move in cycles and leadership often changes hands in equity markets. And that is why we've seen the recent shift from value to growth. In other words, the rebalancing of portfolios and rotation from the tech stocks to financials and healthcare. Now, what the vaccination and stimulus package has done is actually put more upward pressure on interest rates and higher anticipated fear of inflation. And so we'll take a look at the performance of one of the value ETFs versus the growth ETF. We can see that around mid to late November, the value ETFs began to outperform the growth ETF and has continued to date, and has outperformed the growth ETF by nearly 10%. And as we can see from the US 10-year and the US 30-year, as inflation fears rise, they will continue to rise in the foreseeable future. And so let's look at the breakdown of the value funds holding to get a better idea of their composition. We can see that the majority of the sector weighting falls under financials, coming in at 20%, and the second largest is in healthcare, nearly 15%. And these are also some of the top 10 companies by weighting. You have companies like Berkshire Hathaway, JP Morgan, Bank of America, and Johnson & Johnson. And so another key theme, an opportunity we find attractive, is the IPO market. Now, the year 2020 and 2021 will go down in the record books not just as the year of COVID, but also as the year of the IPO. Last year alone, the amount of money that has been raised has been at its highest since 2010, nearly a decade ago. And the global volume of IPOs, they account mostly for the tech sector, coming in at 41%. And the second largest sector is the healthcare sector, coming in at 13%. So this actually creates a very attractive opportunity for the IPO market, and can be largely explained by the massive technological advancements in our day-to-day lives and the digitization of economies. And despite the COVID crisis, what it has actually further accelerated sectors like biotech and healthcare. And so it is crucial to pick the right IPO. And when investors and traders are generating substantial returns, so they look at the ones that have already came out, they're going to look at the new ones. And so that is why I've highlighted the Renaissance IPO ETF, which is one of the most popular and top performing IPO ETFs. And as you can see, if you take a look at their 5-year average annual return, produce a return of nearly 22%, compare that to the benchmark index of around 14%. And on a 1-year average annual return, we see the results are significantly different. We have an 85% return versus a 15% return, nearly 70% outperformance. And so it comes to no surprise that the largest sectors are the tech sector, coming at 51%, and second largest is at healthcare at 14%. And these are also some of the top 10 holdings. Just to mention a few, you have companies like Zoom, Uber, Pinterest, Slack, and Lyft. And finally, one key theme investors and traders should watch out for is the global adoption of ESG standards. Now, we may not feel it here in this region, but in the US and especially in Europe, we have started to see institutional investors and asset managers exclude companies that don't fall under ESG standards. So what does that mean? It potentially means that institutional flow could be cut off from certain sectors and industries. And so ESG is comprised of metrics which are the following: environmental, social, and governance. They don't only take into account the financial considerations, but they also take into account the non-financial considerations. So, meaning the long-term impact on society, environment, and the ethical governance of companies. And more importantly, it has been clearly mentioned by the Biden administration for more ESG disclosure and transparency. And so one trend that is emerging and will continue to emerge in the years to come is the renewable energy sector. And I've placed a chart here for you guys to see. This is the iShares Global Clean Energy ETF, and we can see on a one-year return has produced around 98% versus the S&P at 46, so a clear outperformance of nearly 40 to 50%. And if we look at the breakdown of the fund's holdings, again, we see the renewable sector coming in at the largest at 32%. And some of the top 10 companies by holding are companies like Vestas, First Solar, Plug Power, and Enphase. And so it's clear that ESG standards may materially impact the investment risk and reward. And so managing social and environmental factors is a part of sustaining and maintaining a competitive edge in today's global economy. I hope you guys liked my presentation. It was a pleasure speaking to you all, and meet me at booth number 5 for any further questions. Thank you.